This is a market that appears to be firing on all cylinders right now.
Well, it does appear that some animal spirits are back and that there's increased optimism in the market. You have not just indices at all-time highs, but maybe more importantly, interest rates have bounced back. The 10-year close to 194. You have a re-steepening of the yield curve. And when you look across history at both the late 90s and during the mid-2000s, when you had this re-steepening of the yield curve, that did extend the market cycle and also the rally by a couple years.
Are higher 10-year yields good for equities?
So we think they reflect significant optimism, especially around things like trade deals. And it's really the shape of the yield curve. So you have a yield curve that is a much more normal shape, partly because the Fed has cut rates a few times. And so on the flip side, of course, that's also propped up equities. So we are generally positive over the next 12 to 24 months. We think earnings can reaccelerate. The challenge right now, though, is that there's almost too much optimism in the market.
Well, that's the biggest risk. Too many people on one side of that boat.
That's right. Yeah, I think the prevailing narrative that's driving that is that if a trade deal is done, which is, of course, sort of this binary event in the market, if it is done, that'll lift up manufacturing, get us out of this manufacturing recession. We'll see GDP reaccelerate and therefore earnings reaccelerate. And I think the unfortunate fact about that is it's just going to take longer than expected. You're not going to see this overnight change in manufacturing. And earnings right now, analysts on Wall Street, consensus earnings are expected to be around 10% each of the next 2 years.
So
and we think that's probably too high.
Are people, the markets, are we being too optimistic vis-a-vis equities?
So we are generally still positive, but we think these 10% earnings growth numbers that are expected and are baked into valuations right now, we think that they're probably a little bit too lofty. Somewhere around 5 to 6% around the historical average for earnings growth. We think we could certainly get back there.
Should we be selling stocks then?
Probably not selling stocks. We think a neutral outlook on stocks.
But don't put new money in the market right now.
Well, I would talk about it from a portfolio allocation perspective. Whatever your neutral stock allocation is, we would stick to that for now.
Okay, so if you're at home and you've missed this rally the last couple of years, well, don't do that. But if you did do that, what do you do now?
Yeah, we would basically stick to that portfolio allocation that makes sense. If you did miss the rally so far this year, which was basically just a bounce back from that significant volatility that we saw 12 months ago, basically stick to your portfolio allocation. We'll make it up over the long run.
All right, but otherwise, things are pretty amazing what the change was. Remember the inverted yield curve in August? Everything was doomed. Yeah. Everything, imminent recession. God, we turned around, didn't we?
Well, the story points over the last 12 months really haven't changed that much. The only biggest one that's changed is the Fed. 12 months ago,
maybe a little more optimism about a favorable outcome on the trade fight.
Well, that's true, but that's also happened here and there over the last 12 months. If you go back to March, we were talking about tariff deadlines and maybe some deal would get done. And here we are in November, and we still have the same headlines. So really, the only difference is that the Fed has become very dovish over the last 12 months.
It's like a 3-hour